in order to provide reasonable assurance whether an entity's financial statements are free of material misstatements and whether internal controls over financial reporting are operating effectively. Auditors have to exercise due skepticism to evaluate and test data integrity and security of all sources of relevant information. Good morning, good afternoon, and good evening. Ladies and gentlemen, welcome back to my channel. I'm Anish, and in this video, we'll check out how blockchain, a distributed and decentralized technology which can operate independently of any intermediary or authority, combined with immutability, that is, transactions once validated cannot be modified, is revolutionizing the pace of financial reporting by providing auditors access to unalterable and verifiable audit evidence. Blockchain is the next big step in accounting. Instead of maintaining separate records based on transaction receipts, companies can create a digital ledger, which is a distributed register jointly maintained by all parties to the transaction. Each transaction record represents a block which refers back to previous blocks, and thus all blocks in the chain are linked together. How? Through hashing. Each block generates a unique code called hash embedded into it. The hash represents the digital fingerprint of the data stored in the block. So each block refers back to the previous hash, that is, the hash of the block immediately preceding it, and thus creating an entire chain of blocks. And the first block in the chain that doesn't contain any previous hash is called the genesis block. So when a participating node changes any data within a block, the hash of the block also changes. With this, the entire chain of blocks succeeding the modified block collapses, because the block immediately succeeding the modified block refers back to the original previous hash of the modified block, which is rendered invalid post modification. Another added layer of security in blockchain is the application of consensus protocol. Essentially, blockchain is a distributed ledger, which means that each participating node connected to the blockchain maintains an identical copy of the ledger. So when one participant wants to send value to another, all other nodes in the network communicate with each other using a predetermined mechanism to check whether the new transaction is valid. This mechanism is called consensus algorithm. Once a transaction has been accepted by the network, all copies of the ledger are updated with the new information. A participating node cannot alter or delete entries which have been validated by the network. In other words, a node cannot modify a block without first synchronizing the proposed change with the rest of the network. A properly functioning blockchain is thus immutable despite lacking a central administrator. Since the arrival of blockchain in 2009, its usage across business domains have increased and they have exceeded far beyond its initial cryptocurrency applications. So let's check out various industries where interest in blockchain and its transformative benefits have been high. First is real estate sector. Blockchain is an excellent solution when many parties need to access, create and maintain records over extended time frames. And one such classic example is decades-long real estate life cycle records. So governments are exploring blockchain to support notaries and property registries. Secondly, healthcare organizations are exploring the use of blockchain to secure the integrity of medical records, patient billings, and insurance claim adjudications. Blockchain provides governance in the form of smart contracts. Blockchain can set business rules about a transaction by enabling smart contracts whose terms are recorded in computer language, which can be automatically executed. Simply put, think of a situation where an invoice pays for itself after verifying that the delivered goods have been received in accordance with the specifications and also that sufficient funds are available on the company's bank account. A smart contract makes sure that every part of the transaction is validated, automatically triggering the next required action, all in real time. Let's understand this by way of an example. Two parties could use smart contract to enter into a derivative contract for hedging the price of oil at the end of the year. Once the terms of the contract have been agreed to, it is appended to the blockchain and the wagered funds are held in escrow, also registered on the blockchain. At the year end, the smart contract would read the oil price by referencing a trusted source defined in the smart contract, calculate the settlement amount and transfer funds to the winning party. So, ladies and gentlemen, that's all for today. Thanks for watching, and please let me know how management should find ways to leverage blockchain's benefits in the comment section below. And please do hit a like, share and subscribe. Goodbye, take care.